A few years ago, I had a friend get turned down for an apartment. Good job, steady income, no criminal record, nothing sketchy. The landlord just looked at one number and said, no. Not a bank statement, not a reference letter. A three-digit number most of us only think about when we're applying for a credit card. That's what we're talking about today. Your credit score isn't just a loan thing. It's quietly involved in more decisions about your life than almost anyone tells you up front. So let's start with the obvious stuff, because you probably already know this part. Your credit score affects whether you get approved for a mortgage, a car loan, a credit card. It affects your interest rate. A lower score doesn't just mean rejection. It means you pay more for the exact same money. Someone with a great score and someone with a mediocre score can borrow the same $40,000 for a car and end up paying thousands of dollars. Apart in interest over the life of that loan, that part isn't a secret. What's less talked about is everywhere else this number shows up. Landlords check it, like my friend found out. In a lot of places, especially competitive rental markets, your credit score functions as a character reference before the landlord has even met you. Some will reject you outright below a certain threshold. Others will approve you but demand a bigger deposit, sometimes double or triple what someone with strong credit would pay up front, just to offset their perceived risk. Insurance companies use something called a credit-based insurance score in most US states, and it's allowed to influence your car insurance and homeowners insurance premiums. Two people with identical driving records, same car, same zip code, can pay noticeably different premiums because one of them has weaker credit. It sounds strange when you first hear it, insurance pricing tied to how you pay your credit card bill, but statistically, insurers have found a correlation between credit behavior and claims. So the practice has stuck around and it's legal almost everywhere in the US, with a few state exceptions, like California and Massachusetts, where it's restricted. Then there's employment. Not every employer does this, and some states limit or ban it, but a chunk of employers, especially in finance, government, and roles involving money handling, will run a credit check as part of the hiring process. They're not seeing your actual score in most cases. They're seeing a modified credit report, but late payments, high debt loads, collections, all of that is visible and can factor into whether you get the job. Even utility companies get involved. Set up electricity, gas, or a phone plan with weak credit and you might get hit with a security deposit that someone with strong credit skips entirely. So, why does one number carry this much weight across so many completely different industries? The honest answer is efficiency. Landlords, insurers, employers, lenders, none of them have time to deeply investigate your personal financial responsibility from scratch. Your credit score is a shortcut, a compressed signal that says, historically, does this person pay what they owe, on time, reliably? It's not a perfect signal. It doesn't know about your income, your savings, your intentions. It just knows your payment history and how you use debt. But because it's standardized and easy to check, it became the default trust mechanism for a huge chunk of adult life in a credit-based economy. Here's the part that actually surprises people once they understand how the score is built. Your income has basically nothing to do with your credit score. You can make $200,000 a year and have a mediocre score. And you can make $40,000 a year and have an excellent one. The score isn't measuring wealth. It's measuring behavior. Do you pay on time? How much of your available credit are you using? How long have your accounts been open? Have you applied for a lot of new credit recently? What mix of credit types do you have? Those 5 factors, weighted roughly as payment history around 35% and amounts owed around 30%, according to the most widely used FICO model, make up most of the calculation. Notice what's missing: salary, savings account, balance, just job title. None of it is in there. That's actually good news, because it means the score is one of the few financial metrics that's almost entirely within your control through habits rather than income. You don't need a raise to fix it. You need consistency. The most counterintuitive thing I can tell you about credit scores is this: paying off a credit card and then closing it can actually hurt your score, not help it. It feels responsible, right? Pay it off, cut it up, be done with debt. But your credit utilization ratio, how much you owe compared to your total available credit, is a big chunk of your score. Close a card and your total available credit drops, which can spike your utilization ratio even if your spending didn't change at all. Same thing with account age. Closing your oldest card can shorten your average account history, which also dings the score. Sometimes the financially cleaner feeling move is the one that quietly costs you. So what actually moves the number in the right direction without needing a finance degree? Pay on time, every time. Since payment history is the single biggest factor, keep your utilization low. Ideally under 30% of your available credit, and lower is better. Don't open a bunch of new credit accounts in a short window. Since each hard inquiry has a small temporary impact, and a flurry of them looks risky, let old accounts stay open when you can. Since account age works in your favor, the longer it sits there. And check your actual credit report periodically, not just the score, because errors happen more than people assume, and disputing a mistake can bump your score without you changing a single spending habit. None of this is about being rich or being poor. It's about being predictable to a system that was never built to know you personally, only to know your patterns. And once you see how many doors that one number quietly opens or closes, apartments, insurance premiums, job applications, interest rates, it stops feeling like a minor financial detail and starts looking like one of the more consequential numbers attached to your name. I'll say this clearly because it matters. None of this is personalized financial advice, just general information to help you understand how the system works. So make decisions based on your own full financial picture, and talk to a qualified professional for anything specific to your situation. If this helped make sense of something that usually gets explained in confusing jargon, consider subscribing. This is exactly the kind of stuff we break down here every week.